In this video, I'm going to talk about what exactly is slippage. Stay tuned. Hey traders, a very warm welcome to you. Okay, so have you heard this phrase, slippage? What exactly does it mean? Let's have a look at it. Okay, so I want you to look at this scenario here. You have a market. This could be a stock, this could be currency pair, could be an index, could be commodity, whatever it may be. So let's say we're going to use a stock as an example. We have a price, a bid of 55.82, and we use it in dollars. Imagine we're trading a US stock here, and we have an ask of 55.83, for example. And this is, I'm using this analogy because this is the kind of the best way to explain what's going on. And if you're not aware of what bid and ask, go and check out a previous video I've done where I did talk about kind of the bid and ask and what have you. But you're probably familiar with this. If you're trading currency pairs, you know the score. It's what you can sell at and what you can buy at. Same if you're trading the indices. Same kind of thing. If you're buying at the ask. If you're selling at the bid. Traditionally speaking, if you're trading through a spread betting or CFD, that's exactly what you're doing. You're taking what's on offer. If you're trading direct in the market, it's a little bit different, but we're not talking about that in this video. Okay, so I'm going to come along and I'm going to, let's say there's 100 shares available there, and let's say there's 200 shares available there. And we're going to use an analogy in a second with other bits of slippage. So next level on the ask would perhaps be 45.85, and there's 1,000 shares. Right, so I come along and I say, all right, I want to have a stop loss on my short position at 55.83. I've got 1,000 share short position. I've been short from 55, for example. I've got an 83-cent stop. The market has gone up, and a stop loss means it will trigger a market order when the price trades at 55.83. We can, there's variations of that, but traditionally that's what happens. So what does a market order means? It basically means buy me 1,000 shares at whatever price you can. So you may have your stop at 55.83. That's just the trigger point. By the time your order gets to the market could have moved. In this scenario, the reason we're going to get a different fill from the price we wanted, we're going to get a fill. We're going to have 100 shares taken there and 900 shares taken off there. We're going to get a mixture of 85 and 83. We're going to get 900 shares at 85, 100 shares at 83. Going to make our price more like 85 or 84 point, whatever that figure is. That's our slippage. Another way we could get slippage is, let's say the market is trading very, very actively and it runs straight through that level. It prints the 83, 85, 86, 87. By the time our market order goes in, we're getting a poor fill. Let's show this example on a currency pair like pound, US dollar, because the volume at each level isn't really important here. So we have, or let's say we've got an imaginary currency pair, country A, country B, and let's say that the price of that is 99.86 to 99.87. Okay, and we have a stop at, let's say we have a stop at, let's go the other way around now. Let's say we have a sell stop. So this is our bid, and this is our offer or our ask, and we're long, and we've got a sell stop at 99.86. All of a sudden, the market does this, okay? It's been chugging along quite nicely. All of a sudden, we get a heavy down move on a 1 minute chart, right? And it's going through, this is our 99.86 level right here. Okay, we've had a stop under our low, whatever it may be. So let's say we're looking for, I don't know, 10 pound a point if we're spread betting, 10 CFDs if we're using a CFD, or 10 whatever way you choose to trade. All of a sudden the market comes down. We've got a sell stop for 10 at 99.86. The market trades at 99.86, but actually because it's going so aggressively lower, it's trading 85, 4, 3, 2, 1. Somebody has taken a big block, or a lot of people have taken a big block. So by the time our stop loss is triggered, by the time our stop, which says, hey, sell me 10 at 99.86 is triggered, by the time the order gets put in, the price could easily be lower, and we could be getting filled at 99.83, 99.82, or even worse. You know, we've had scenarios where big data has come out or big news has come out and this thing just swept lower, and by the time everyone's stop has been triggered, you're getting poor prices. So when can this happen and how can we avoid it? So this can happen obviously out of nowhere during market hours. If we're trading a small enough size, we're not usually going to get this on currency pairs. It's possible, but it's not as usual. If you're trading outside of hours and you're trading something thinner, then expect it. Let's say you're trading gold and you get some after hours movement, you're going to get just gaps in price as well. Like the next price is not going to be 88, it could be something like 93. So your slippage is going to be the next available price. So you've got to be careful of that. You could also get it on big spikes in movement. So if you've got non-farm payrolls, US economic data, anything like that where you're getting big volatile movements, expect to get slippage. Now, how do we avoid it? Well, you know, you really can't avoid it as such. It's a yin and yang kind of payoff thing. If you're using a stop market, by the way, this could be to get into a trade. You could be using a stop market to get into a trade as getting out of a trade. Most of us use a stop to get out of a trade. How do we avoid it? Well, we can't avoid it completely. We can avoid it, but then we have to take a hit on something else. What I mean by that, we can say to ourselves, hey, listen, you know, I use a stop limit order, which means that I will put an order in to let's say we're going on the same example here to sell 99.86, but it's a limit and the stock will only trade at 99.86. So if the next available price is 83, 84, 82, it won't execute. It will wait until the price comes back up to 86 to execute. Now, obviously you can see the advantage of that is that you're not getting anything worse than 99.86. But the big disadvantage is that if that price keeps going lower and lower and lower, you are still in the trade. You are not getting stopped out. So maybe you could use a hybrid. Maybe you could say, okay, stop limit order at 99.86, but an emergency stop at 99.75 or something like that. And then we'll have one cancels the other. So, but in reality, guys, you know, if you're taking a bit of slippage, it's the way it is. It's gonna happen to you. It's a cost of doing business. If you want to get out of the position, you want to get out of the position. Same as you want to get into the position as well. Same as if you're buying at market. Any kind of market order, you will get slippage. It just becomes more evident when you're using a stop, because the stop you put in an actual figure, you want the stop to be like 50, you get filled at 49, you say, well, I've got a penny slippage, I've got a tick slippage. Whereas when you're buying at market, yes, you might see the price at 50, sorry, you're selling at market, let's say you see the price at 50 and you short it, you get filled at 49. Yes, that slippage, it becomes less evident because you haven't got a specific anchor point to work from, but that you're still getting slipped. You're still hitting it at a price. By the time you've got the fill relative to the price you hit the fill at, it's less or it's a worse price. So unavoidable, that's what slippage is. It's a case of a difference between the price you expect to be fill at and the price that you're actually filled at. Now, we are lucky, guys, because we're electronic trading now. If you're trading in the pit and you're getting quotes through, you know, coming through a ticker tape or on telephone or whatever, you call in, now you're talking slippage. By the time you've called in, you've put your order in, it could take several minutes for it to be filled. The order goes through. You could be slipped massive amounts between what you see and the price you got. And you only have to go back and read some of the old books about traders in the pit to recognize that was a big problem. We haven't got it too bad. Unless you're trading throwing around serious size, it's not going to affect us too much. But just being aware of when it could happen, aware of the risk potential for big slippage, that's all we want to really avoid. But accepting that the odd slippage here and there, a few tenths of a tick or whatever, tenths of a pip on currency pairs, isn't the end of the world, but knowing why it happens helps us to avoid it and understand it. Anyway, guys, take care. See you in the next video. Bye-bye.